Bloomberg Audio Studios.
Podcasts, radio, news.
It is Single Best Idea, where we take two of our guests across 3 hours of Bloomberg Surveillance and try to give you some wisdom on economics, finance, investment, international relations, and the inflation that we are all living, frankly, worldwide, but also coast to coast as well. 3 months makes a trend, and we are well out to a trend. I saw a great chart. I'll give Jason Furman credit, but it may have been somebody else. Saw a great chart where basically we are reinflating out of November of last year. A first shout out here on Single Best Idea to Jim Bianco. We started early this morning with a gentleman from Chicago, and Jim Bianco absolutely nailed this. I don't know if it's blind luck. You know, like the Chicago White Sox need a pitching staff, just to start there. We need Jim Bianco on more often because he has absolutely nailed this idea of the last mile of disinflation will be hard, and that's certainly what we saw in the report today. Ira Jersey came on and showed us titanic market moves, a 2-year yield on a 5% watch. I can't believe I'm saying that. And then Neil Dutta joined us. And he was really quite good. At the end of his conversation, he talked about the idea that maybe real wage growth is threatened with higher inflation. That was one thought from him. But here's Neil Dutta looking at consumption and looking at the clothes you put on your back.
What I would just say is that you look at apparel prices, they rose, I think, 0.7% in March, and that's following a big increase in February. But taking a step back, people are already making a trade-off, right? So if you look at real consumption of clothing, it's already declining. So in some respects, that is not the kind of inflation the Fed should be worried about. I mean, that's not demand-driven inflation. If people are cutting back in the areas that are going up in price, that suggests that people are making a trade-off already, and there's somewhat resistance to higher prices, which then raises the question about how long those price increases can stick.
I'll give you demand-driven inflation. Afterthought said, we need some steak in the house because we're like everybody else. We're eating chicken 8 days a week. I mean, it's a shift from beef to chicken. So, I called up the fancy place and I said, can I get a steak? I thought they'd send two. Instead, they send this one ginormous steak, which cost $32. And it was, more than a pound. It was like a big, ginormous piece. But I can't even scope and scale that. $32, and I had to cook the beast. And that's the kind of examples we're seeing. So the answer is we all eat chicken. And that's the substitution effect that you see on in inflation. It's a very, very real problem. We also talked to Steve Ricchiuto of Mizuho, and he was really, really quite good here. Here's Steve Ricchiuto on the shock of an inflation report.
At the end of the day, they're trying to maximize social welfare. And their concept behind keeping the labor market as tight as it is to try to drive up wages. The problem is by keeping the labor market tight in an environment where all the excess capacity has been used up in the system is it creates inflation. And that's when you get into the situation, as you indicated a few seconds ago, in terms of negative real wages. So your attempt to try to maximize social welfare by keeping a labor market tight could go against you if CEOs and companies feel they have pricing power. And after seeing this kind of improvement in the data, you're starting to see that, again, that's a broad-based improvement in the inflation numbers or rise in the inflation numbers, is telling you that more and more people feel they do have some pricing power left. And that's why it's working at the detriment of their desire to maximize social welfare.
Steve Ricchiuto of Mizuho, and my question is, you look at the three components, you can do it in a fixed income space, the nominal yield, the yield that we all know. What's a mortgage rate going to be after this inflation report? And then you take away inflation and you have a residual, which is the real yield, the real 5-year yield, well out over its 2 standard deviation move. 10-year yield, almost as exciting, to a higher, I believe it was 2.09%. Or you can bring it over to the economy and look at nominal GDP, the current GDP, which is all in with inflation. This goes back to Lawrence Kudlow years ago at Bear Stearns, where he really fought for the importance of nominal GDP. Take out inflation, and you get the residual, which is the thing we talk about all the time, real GDP. So you got 3 moving parts. And I'm not really sure where those moving parts are headed right now. I think that's a massive uncertainty that the Fed faces at a May meeting. They're just going to do nothing. I mean, is it going to be a snooze fest? I'll show up. The Fed decides. I'll be there with John and Lisa. We'll see what the May meeting's like. But where is nominal GDP? And then when you take out this new higher inflation set, where is real GDP? That's going to be fascinating to see what the growth of the American economy is. Major shout out to the gentleman up at Harvard holding court, Jason Furman, his public service to the nation in the White House. But Jason Furman with a beautiful historical perspective. I don't have the numbers in front of me. What you need to know that on a 3-month annualized, on a 12-month annualized basis, we are back to inflation of the early 1990s. We're out on Apple CarPlay. Thank you so much for your effort there. Worldwide on Apple CarPlay. Download the business app and the Bloomberg business app, I should say. And also on YouTube. Just extraordinary attention to YouTube. Thank you so much. You go to YouTube, you search Bloomberg Podcasts. Look for Lisa Mateo. It's a better look than looking for me or for looking for Paul. But we thank you for your interest on YouTube. This is Single Best Idea on Apple Podcasts.